The taxation is a very important part. While you need to build up the corpus on your investment, it's also essential to know how you could be impacted through the taxation. So you need to look out for the better option as when to withdraw them accordingly so that the taxations are minimum. So as of year 2024, if you look at it, this is the big picture of the taxation. So if you look at the stocks, there are two types. One is the short-term capital gains, and then there is a long-term capital gains. So this is for earlier meaning prior 2023, and now it is now long-term capital gains mentioned over here is for 2024. There is a change in the taxation in the current budget. So if you're holding the stock or your mutual fund for less than the year, it was 50%. So if you're a short-term investor, you want to procure it and look at the ways and sell it across. Earlier it was 15%. Now it is 20%. Particularly this is for the traders. But for the long-term investors, earlier long-term that is more than a year, it is earlier it is 10%. Now they slightly increased it to 12.5%. But there is a catch here. This is what you need to look at. The annual, that is per annum, that is long-term exempt capital gains has been increased from 1 to, so there is a gain over here. So you need to effectively use that, the stack, that is 1 to 1.25 lakhs. So that means if your long-term capital gains is less than 1.25 lakhs, then there is almost, not almost, there is a nil tax. So this is for all your stock market related, and this is for your real estate and bonds. So not much. I mean, only as far as the real estate is concerned, there was they reduced it, but the concept of indexation is removed now. So that I will not be going into it. But yes, for the real estate, there could be some impact. The point to note here is, I mean, if you're an investor, long-term investor, and you want to gain most out of it, always look for long-term. So stay invested for more than a year. That is very important. And post that also, you have options that we'll see in this slide. So the concept of tax harvesting. So based on what is your long-term capital gains, you need to plan accordingly. Tax harvesting is to reduce your long-term capital gains. You need to first know how long the term capital gains are taxed, how long, and what is the percentage, is there any exemption. All these needs to be known, and then you do the tax harvesting. So example, let's say X invest about 30,000 in mutual fund in 2006, and now it is approximately assume he is not taken the fund at all. So probably he was well employed, it was just for a long term, he didn't take the fund at all. Well, that means it has accumulated to about 4 lakhs as of 2024, the investment of 30,000. We know that long-term capital gains is 12.5% and exemption limit is 1.25 lakhs. So ideally what you need to do is, if you are going to take the entire fund, withdraw the entire amount, whatever, it could be 4 lakhs, it could be even the best mutual funds, it has gone to 7 lakhs or 8 lakhs or whatever it is. And if you have, suppose it is just an example, another mutual fund also you have invested about 20,000 INR in 2007 and it has gone to about 3 lakhs. So you want to withdraw, ensure that you don't withdraw more than 1.25 lakhs per annum. So if you're not going to withdraw 1.25 lakhs per annum, then there is no capital gains at all. And the concept of indexation might come, but yes, don't withdraw more than 1.25 lakhs. Then it's, so what you could do is, if you still want to continue with that, take this less than 1.25 lakhs, you can invest in mutual fund again if you want to build a corpus. Otherwise, yeah, you can use that fund for your own benefit, which means there is no taxation is applicable. So this way, there could be a workaround. So because there is an exemption limit there, particularly for the long term, it's not there for the short term capital gains, but it is there for the long term capital gains. So you could use this option and ensure that you do tax harvesting appropriately so that it is well within this limit. So taxation is an important part as far as the investment goes. So you need to plan accordingly. So these things are difficult in others like real estate. You cannot. It's very difficult to sell a part of your house, whereas it's possible with the mutual funds. You share. I mean, mutual funds or even shares. So you sell only if you have 10 shares, sell only two. Similarly, the mutual fund also you sell only a part of it. The rest will stay invested. Whatever is withdrawn, you can reinvest so that you can build the corpus, or maybe you can use part of it for your own expenses, and you can reinvest so that you don't get taxed. So these are all the tax planning you need to get involved during the course of time as you build your corpus. I hope I found this useful. Thank you and cheers.